Welcome back, fellow investors. In this video, I'm going to be covering CVS Health. This is the pharmaceutical slash healthcare provider that is been doing really well from a growth perspective on revenues, profitable, paying a good dividend. But their stock hasn't been doing all that great in 2023. Will things change after this earnings? Well, I'm going to take a close look and see what I think the company is worth using an evaluation that looks at free cash flows as well as earnings per share. I'll take you through my process of investing, and what I use is my guide to make a decision whether I want to buy, hold, or sell shares in a particular company. Do me a favor and like my video and subscribe to my channel. And please leave a comment. I'd love to hear your thoughts on CVS. Now let's get into my process and take a look at CVS. CVS historically has been a pharmacy, but I really like that they have continued to branch out and diversify. They are a healthcare payer. They acquired Aetna and are a payer, and they're actually providing healthcare services now. And the growth parts of the company are the healthcare payer business, as well as the healthcare services businesses. Those businesses are really growing, and it's making CVS different. It's making it more valuable to all the different customers. So all those things I really like about the company. I believe they're the leader within their category of being a pharmacy slash healthcare provider and healthcare payer. I really like the strategy that they've taken. I think their management team's doing a great job. On November 1st, CVS announced their earnings, and I'd like to review that. First, their top line revenues grew at 10.6%. That's very good because CVS is a really large company. They were profitable in the third quarter. Very good to see. Last year, they were unprofitable in the quarter because they had to take some extra charges. Looking at how they've been able to forecast their business, they've been able to forecast really accurately. On August 2nd, they had a forecast, and they basically came in around those revenues on this particular earnings release. For the full year, they're forecasting that cash flow from operations are going to be $12.5 to $13.5 billion. And I'm going to be using that as part of my free cash flow estimation. Last item is they reiterated their full year guidance, going to show that they really know their business and they've been really forecasting accurately. It's a really good sign that the management team is doing a good job. Looking at their income statement, a few things I wanted to point out is they are nice and profitable for the quarter, nice and profitable year to date. They've been buying back shares, so you're seeing the share count come down from last year to this year. So they pay a nice dividend and they're buying back shares. So that's really good. The one area that's a concern is the balance sheet. If you look at net debt compared to EBITDA, it's at 3.31, and I need that to be under 3. So this does not get a passing grade. It is too high, and that's going to be a concern for me. Primary issue is that their debt, long-term debt went from 50 billion last year up to 60 billion plus the amount that's in current debt. So that $10 billion of extra debt really changes, the ratio and adds more risk to the company. So for free cash flow, I'm going to use the guidance that CVS is providing. They're providing that cash flows from operations are going to be between $12.5 and $13.5 billion, and they're going to spend $2.5 to $2.7 billion in CapEx. So I'll take this number, take away CapEx, and then get to my free cash flow number and use that in my valuation based on free cash flow. I believe CVS is discounted by 25%, and that's based on two valuation methods, using a value of all the free cash flows and a net present value of those cash flows, as well as the net present value of earnings per share that I expect from the company. Let me take you through the valuations and then come back to this number. So the guidance is that they're going to generate about $9.8 billion of free cash flow in 2023, which is a really good number. I'm going to grow those cash flows by 4% over the next 4 years. And then after that, for terminal value, I'm going to grow at 3%. The company's doing well, and I really like those high free cash flows that CVS produces. I'm going to discount those free cash flows by weighted average cost of capital of 10. I increased it by 1% because their balance sheet isn't looking as great as it did before. And based on the free cash flows I expect discounted at a 10% weighted average cost of capital, I get to $133.5 billion of value for those free cash flows. I'm going to add the cash to that amount and take away the debt they have to get to a equity value of $87.8 billion is the value that I estimate for those free cash flows. The company has a market cap of 88.3 billion. So it's basically being sold at a fair value if you just look at free cash flows for CVS. Earnings per share look good, and next year looks really good. They are operating really well. So earnings per share for the next 4 quarters, I estimate is $8.44 per share. A good solid PE for this company in this industry is 18. Grow those earnings per share by 3%. And use this calculation to discount those earnings per share that I expect in the future. I get a value of each share of $120.31, but you can buy shares for $68.81. So it provides a 75% discount if you look at earnings per share. I blend these two numbers to get to a blended value, but I put more weight on the free cash flow method. I actually used 2 parts free cash flow and then 1 part earnings per share to get to a blended discount of 25% on CVS. Looking at the stock where it's been over the last 5 years, you can see that it was riding high in 2022. It was actually above $100 per share. And the same company that you could have bought for $100 a share then is now discounted significantly because the price of the stock has really come down. And I have a valuation on the stock of $85.77. So it has, a pretty decent discount of 25%, which is okay. But you can see where the stock's really been. It's down 26.9% year to date, but it pays that nice dividend at 3.5. Let me complete my investment evaluation decision on CVS. First, all about the company. Do I like the business? Do I like the industry? Do I like the management team? And it's yes to all 3. I think the company is the leader in their space. The team's doing great out there. I like the industry. Debt is the problem. They're above that 3, and I think the company can fix it if they can pay off some debt, or if they can increase their EBITDA, they can get that below 3. But for now, it doesn't get a passing grade. And the discount's okay. 25% discount on a quality company. Hey, that's a discount. But I'm going to be holding my shares of CVS, waiting a quarter or 2 until that balance sheet gets back into an acceptable grade. That's my analysis on CVS. I hope you found it interesting. And I'd love to hear from you what you think on CVS. Please leave a comment on what you think of the company. Do me a favor and like my video and subscribe to my channel. And good luck investing for the remainder of the year.